If you are looking to buy your very first business using an SBA loan, this video is a must. Watch me as I interview Marie Askew from Live Oak Bank, the #1 producer of SBA 7A loans in the country. Watch me as I ask her the top 20 burning questions I get week after week from hungry buyers looking to buy a business, and listen to what she has to say and her answers to those questions. Let's get to it. Hey everybody, welcome to my channel. I am your host, Leo Landaverde, business broker and commercial lender, helping you buy and scale a profitable business. If you are a small business owner looking to increase your wealth by buying a profitable business, or a W-2 employee sick and tired of the rat race wanting to become the CEO of your very own company by purchasing a profitable business, you are in the right place. Please subscribe to my channel. Don't forget to hit the bell. You'll be notified every Thursday when a new video comes out.
Hey guys, so I am super excited today. I get to have my colleague and friend, top SBA lender, Marie Askew with us on the show today. Say hello, Marie. Hi. There she is. She's so excited. She's got the questions and the answers to your hot questions. So what I'm going to do is I want to tell you a little about her by reading her bio, and you'll see why she's here. So Marie Askew is the vice president at Live Oak Bank, SBA, M&A, and owner-occupied real estate lending nationally for Live Oak Bank. With a proven track record in SBA and commercial lending, Marie brings extensive experience, drive, and enthusiasm to Live Oak Bank and her customers. By cultivating strong relationships with her clients and network, she has garnered a robust understanding in M&A, owner-occupied real estate, and ground-up construction. Through the course of her career, she has successfully navigated complex loans to successful close and have been responsible for ever-increasing SBA production nationwide. Her contribution and ambition for helping businesses grow and succeed have earned nationwide recognition. Yay! 2019 Business Development Officer of the Year. Hello! Top Producer Award in 2008, 11, and 22, as well as recognition in the Circle of Excellence. Through her passion for learning new environments and exploring diverse cultures, she has spent 8 years abroad, where she became fluent in Spanish. I may just switch to Spanish at some point. Not just kidding. We'll keep it in English for my U.S. people. She has had completed an MBA in finance. She lives in California and proudly serves businesses across the U.S. Without further ado, here is Marie Askew. All right, how are we doing?
Good morning. Thank you so much for having me, Leo. It's such a pleasure. I appreciate it.
Awesome. I know that this introduction does you justice. I mean, this is great. So what we've done, guys, for those of you watching, whether it's today, this is an evergreen video, is we have taken, we're going to do this in two parts. We're going to do the buy side first, and we're going to do the target business later. We have 13 questions that have been curated from comments and emails, over hundreds of emails and comments that I've gotten. Those are the top 13 questions that a buyer will ask an SBA lender, and Marie will answer those questions for us. And then we're going to come back and do the target, which is going to be a separate video because it will be over 2 hours. So we're going to keep it to about 55 minutes to an hour each video. So it'll be 2 parts to this interview. So part 1, here we go. Net worth. What if a buyer doesn't own real estate? What's the story that we're there?
This is a great question. And I always like to lead with this for borrowers, because if they do not own a primary residence, that does not exclude them from purchasing a business. However, if they do own a primary residence, then it is required to take it as collateral if there's more than 25% equity in the property. This does include, rental properties, or if they own a commercial piece of real estate, there may be additional cost to that. They may have to get an environmental or an appraisal. Or one thing that I see often for primary residences and collateral is that if one partner owns a residence and then one partner does not, then the bank is still going to take the the primary residence as collateral of the one partner, even if the other partner does not have a piece of property, if there's 20% or more equity. And under the new SOPs, so the personal resource test is eliminated. So regarding the net worth, SBA lenders are no longer going to consider the personal resource test that we used to have to use, meaning borrowers can't be too liquid to qualify for SBA loans. So I think that this is some really good changes to the SBA program, as well as hopefully it clarifies, individuals, if they own a primary residence or if they don't, they still can qualify.
It's so great to know, because I think there's a misconception.
Misconception.
And even years ago, that if you didn't own real estate, you couldn't really be able or participate on an SBA loan, which, that's really a myth. You don't have to own real estate.
I agree. And I think that there's also, like in California, especially our higher cost of living areas, it's more difficult to obtain a home. Certain pockets of Southern California, the Bay Area, it's not uncommon for individuals not to own a primary residence, but they still are eligible to qualify for an SBA loan.
Awesome. Okay. Number 2, what about industry experience? Does the buyer have to have like for like industry experience in the same industry vertical? Why or why not? And what do you look for?
Yeah, so this is also a great question. I always ask borrowers, like, tell me a little bit about yourself. Like, why this business? What is it about this business that speaks to you or has led you to be interested in this business? And normally there's a connection or a story of how they've, come to select this business. But there is a requirement for direct industry experience, which is basically defined, as experience gained through owning, managing, similar business or working in a specific industry. So some businesses that you would want to have more of a higher level of industry experience would be hospitality, gas stations, car washes, restaurants, like those types of industries. Not anybody can just walk into, and you should have some type of related industry or hands-on involvement with those types of operations. But that doesn't exclude you if you haven't worked in the industry. So there is, transferable industry experience. And sometimes that is through transferable skills, formal education, professional certificates, other related industries. So, it's an interesting factor, because for some industries, you may need to work in them and really understand them. But in other industries, you could actually have transferable industry experience that will qualify you for the transaction.
So that's great. I mean, that brings up an interesting point. There are industry types that require a trade license. For instance, plumbing, electrical contractors, GCs, HVAC. How can a buyer who doesn't have the license, what is the procedure? How do we bridge the gap between the departing seller and the new buyer, and for it to make the deal work?
This is a great question, and I think it's very asked often. And I think that a lot of the industries are kind of those hot industries that people are looking at right now. So under SBA, trades licenses must meet certain requirements. So they have to have what they call a responsible managing officer, or RMO, in place. So that requires a business to possess that trades license or demonstrate the ability to obtain them within a reasonable time frame, because you don't want to buy a business and then they have a license that you can't get, and then you can't operate the business. So, and then you got the loan, right? So the bank is there to assist you with the guidelines, and also to make sure that it makes sense for you to, be in a position where the borrower can provide the evidence of a valid trade license during the application process, or they're in the process of legally, gaining that license, or the seller may be able to stay on for 12 months after closing with the licensing, We like to see that the buyers have the license. I mean, that's probably every lender's dream. But the process, some of the borrowers are in the process of obtaining the licensing. So it's also a kind of interesting. It's kind of like, well, where do you get, the experience without having the experience kind of thing? So every situation's a little bit different. So, we can always walk through them on individuals, but there's also times where you can have a person on staff that has the license and have an action plan of how you're going to obtain that licensing requirement for, local or, state licensing. I think there's several options for borrowers that are considering those industries on how to structure those deals.
So this is what's happening in real time to me. Like as the channel keeps growing and more people are coming to me. Here's the trend that I'm seeing. I'm seeing professional, high-end, white-collar executives who may have worked at, Microsoft, Google, who do not want to pursue tech or don't want to stay in software, but want to move away from that. They have this core. They know how to run operations, in some cases, even P&L jurisdiction. They know how to build, they know how to hire people. They have P&L jurisdiction. They know how to run an operation. They just don't want to do it in their own field. They have all this knowledge and they are looking more at the trades, what has happened pre and post COVID and how more, the trades actually came out winning. It would always be HVAC, would always be plumbing. We always need the trade, anything that is related to roofing or anything that has to do with a specific trade related to GCs, more and more people are coming to me and says, Leo, I see the writing on the wall. I see those what I call, pain business versus vitamin business, I call them. A vitamin business will be a good idea to have in beauty. You want to look good. But the pain business is my toilet breaks. I got to fix it. My electrical panel goes down. I don't have power, those kinds of things. Can someone make a circumstantial case? Yes, I have not worked directly for an HVAC company. I understand how hard can the business model be. I don't have a license. What would you think of someone like that who is highly educated, has the network, maybe a home or two, has the wherewithal, they may or may not own a business, has a healthy 401k? How will you approach that?
Well, I think it's a case-by-case basis. I mean, you can always look at multiple structures on every deal. It depends on, the background of the borrower. It depends on, if the seller's, deciding to stay on. It depends on if there is other staff that's available for the licensing. And a lot of times it also depends on how long it will take that individual to sit for the licensing. So in some cases, I've had customers that have the elevated degrees and they are like, I can sit for the license, immediately or within a few months of having being part of the operations. So I think that every deal is different. I think that's the beauty of SBA lending. It really is kind of storytelling lending, because no two deals are ever the same. Having to, I've funded, approximately, $500 million in loans, and none are exactly the same. So
two loans are alike.
Yeah, no two loans are alike. So I think for those individuals that are looking to understand that or to move into that direction, they should really understand what it takes to qualify for the licensing and really why they're picking that business. Because if you're just picking the business for, oh, I think it's a great cash flow and I want to exit the white collar business, you may not like that, in plumbing. They're going to call you in the middle of the night. They're going to call you on weekends because their pipes are broke. And so, I think it's good to have the right fit for all businesses and to take everything in consideration.
Well, and this is what I tell my subscribers in my channel. It is really about a circumstantial case. You are the new operator. How will the lender, you have to think in terms of the lender, what will you need to say or have in place in your personal life and your professional life to make the lender feel at ease with lowering and mitigating the risk? We know that the cash flow is coming from the deal. Do they like the deal? Is it evidenced by tax returns? Will it pass all the tests on the debt service coverage? All of those things that we're going to talk about in a little bit. But really what it comes down to is, can you make a circumstantial case for you are the buyer who's going to take this business from $3-4 million in annualized revenue to 8 and have the debt service coverage ratio be moot? You have a zero risk deal is going to be approved any day, right? It's just, is that a good way to put it? A circumstantial case for the buyer?
Yeah, again, I think you said it perfectly. It's a case by case basis, and what may work for one person may not work for another person, just based off of the target business or the individual borrower. But then you may take to a business and a person, and they fit perfectly because of the structure and also the seller willing to help them transfer, or whatever those circumstances can be. So I think that's a hot topic, and I don't think there's a black or white answer in it. I think it is a little bit of a gray area, and on those circumstances, it's you have to talk about it. You have to work through a live deal to really see if what the direction looks like.
You know what? If you've been watching already, it's about 10-20 minutes into this. I know people are asking, oh my gosh, I like what she's saying. She's speaking to me. And, after all, we hear at Live Oak Bank, the top producer of SBA loans in the country. There's a reason for that. So why don't you take, and I'm putting you on the spot, right? Why don't you take a couple of minutes to tell us, I know I like Live Oak Bank, right? What makes you so unique that buyers want to work with you? I think it's time for you to say that.
Well, yeah, I mean, besides Live Oak Bank being the largest SBA producer and 7(a) lending nationwide by dollar amount, for me, the reason that I really love working at Live Oak Bank is because it has the same core values that I've had in my lending career, is that I've treated every customer like they're my own, and like they're the only one. It doesn't matter if it's a $500,000 deal or a $5 million deal or a $20 million deal. All of those loans are for small businesses, which, if you look at the big picture of what small business lending is all about and why the SBA loan program was created, it was to support entrepreneurs. And those entrepreneurs then hire people and feed families, and it goes down from there, right? And I think that Live Oak Bank having specific vertical industry expertise also helps streamline our process, really understand specific industries. So it's not where you're going to get a deal and you send it into a credit team, and maybe they've only seen one daycare deal that year, where our teams, that's all they underwrite. All of our processors in that vertical only underwrite those specific industries like HVAC and self-storage. So they're seeing those deals all year long, and
right.
And our processors are just processing those. So we have a unique process after the deal goes into underwriting, and I can't say enough about our what we call our business group for servicing after the deal closes. Many times when you have a deal that funds, and after it funds, you never hear from your lender again. We have teams of people that review the financials. They'll do the spreads on the financials, and some small businesses, maybe the middle level, more sophisticated businesses have controllers and so forth that can help them with that. But in a smaller business, there is a specialist that does that, all year long, every day, and they really can help the borrowers, and they do reach out to them quarterly and check on the borrowers and see how they're doing. And that's kind of like a concierge service that you just don't get with other institutions. So I really feel that the process, from the front end of how I handle my customers, really meet the core values of the institution, and it continues throughout the process of the bank, as well as, it was one of the first, technology-based banks. It's a cloud-based bank, which was very, cutting edge and innovative. So yeah, I think we offer a really unique service in comparison, and we also have very unique structures too. I can't I can't also, without saying, on a lot of the deals that we look at, we really look at, how do we mitigate risk? How do we help the buyer? How do we protect the buyer? And then how do we get the deal done that works for everybody? So yeah, I think that we do things differently, as it's said at Live Oak Bank.
Well, clearly, you're the #1 player, so you must be doing something right. By the way, to those of you watching this video, please subscribe to my channel. Also, I'm going to put Mary's contact information, whatever she will allow me to put down, that you can get I would be thrilled if you reach out to her directly and just drop my name, just say, hey, I was watching one of Leo's videos, and then Mary will know it's me. And I want to make sure that, as you guys know, I am a consummate, all about the customer service experience. I love my subscribers to be, they will get preferential treatment, and that's why I wanted Mary, because she believes the same things that I do. Without that, with that said, let's keep going. Down payment comes up a lot. The equity injection. Can it be a gift? Can it come out of a HELOC? What about the seasoning of the money? What about investors and partners? How does it all, how do you look at it on a day-to-day basis?
Yes, this is another great question. And this is, every borrower I have, we talk about this. So, down payments can be gifted for the equity injection. Gifted funds can, sometimes, come from personal funds, like they have some of the funds, but then they're short. So they're saying, I'm gonna ask a family member or relative or something of that nature. And as long as they have a notarized gift letter and 1 month bank statement, then they can get gifted funds for their project.
Entire down payment, say the 10% equity injection?
Yes.
Wow.
Mm-hmm.
That's great, you guys. For those of you, I mean, you could be it's all about how you navigate your family and friends relationships, right?
I mean, I think it's always positive to say too that for a borrower, it's always good for them to put skin in the game. So, although it is, you can get it all gifted, but I think a borrower that's looking to, be an entrepreneur, when you put your own money, you have your own skin in the game. And I think that's like a good start. Even if you don't have all of it and you needed to get a gift or something of that nature, always strive to put something, towards the down payment.
To me, my background. I mean, I built from nothing. I believe in skin in the game. I believe, you got to pay to play. It's also it's a test of character, right? Yeah. If you haven't, but it'll be quickly evidenced by, if you don't know how to manage your own credit and your FICO is at 630 or below, you'll be jumping from job to job. Your resume doesn't look that great. You don't have the management experience. And on top of that, you don't have the money for a down payment. Remember about the circumstantial situations. You're not ready to buy. And you probably shouldn't buy, because you haven't demonstrated that you are the CEO type, right? So I know I'm asking these questions because it's asked of me, but now they're hearing it from you, Mary, who actually is a practitioner of a true lender, right? So HELOCs, those do come out, like if you have somebody who owns their home and has a couple of rentals and they has a couple of HELOCs, say, they say you have a HELOC that is, I actually had this happen. Somebody who had a HELOC with a $400,000 with a zero balance on a property that's worth north of $1 million, with a first mortgage at $400,000 and a huge line of credit. They wanted to use the line of credit to purchase a business. How do you treat that? Because you have to trace back the money. Say somebody takes a draw of $200,000 out of the HELOC. How do you connect the dots and the global debt service coverage ratio?
Well, I mean, you can always source that it came from the HELOC. HELOCs are allowed for the down payment, but you have to calculate then the global cash flow to support it. So if you had that zero on your $400,000 HELOC, and then I pull the whole 400 for my down payment, well, then I'm going to have a payment, right? So you want to make sure that, the household is able to, that the business is going to be able to make that repayment of that extra payment of the $400,000. So I think that's, the big picture. If it's either, gifted, get a gift letter, notarized, 1 month's bank statements, if it's a HELOC, we're going to calculate the full cash flow to support that repayment as part of the injection. So
by the way, I know that there you have some collateral stuff that you may be able to share with some buyers. I think the time is now. If I know you're going to provide some things that I'm going to have the links for you guys to download. These are really great tools. I know Lifewell Bank is really ahead of a lot of their competitors in creating collateral materials. If you wanted to calculate some post cash flow, if you wanted to model some of these numbers, I know I have my own tools, but if you have tools to share, I will, as people download them, they will go into my email list, but you will know who they are. Mary, I think it would basically help them qualify themselves. If I pull down 400,000, what does it do to my global debt service coverage ratio, right? Which I'm big on. Yeah, so we will make those available to you. Whatever you want to share with us, Mary, it'll be part of the downloadable package.
Absolutely. Okay. We have a global cash flow for individuals looking to purchase businesses, and they can, kind of play with the cash flow, kind of how it works, and, come to those calculations as part of their own, research. And then they can have, discussions with me or others about what their findings are. So absolutely. And I'll also put the vertical expertise that we have. I'll also put a list of the verticals that we have.
So that's it. I mean, they're gonna somebody who's watching this for any length of time is gonna hear so much, but having this stuff to reinforce the learning, it's great because it takes a lot of learning to buy a business, right? So let's keep going. We already talked about gifts and HELOCs. Retirement accounts is becoming, if somebody's been working in corporate America for 20 plus years, they're gonna have a nice little nest egg with the 401k. From going to the IBBA, I went through their annual gathering in Orlando. There was actually a presentation on Roths, right? And on a C structure corporation. Those are also acceptable, right? If somebody wants to roll over some of their 401k, assuming that the whole picture makes sense, those are acceptable to you.
Yes, Roth rollover programs are acceptable as a down payment. So, what I would suggest is that they connect with their CPA, connect with a Rob specialist, and then when you're talking to your lender, let them know that that's how you're going to proceed for your down payment.
Good. All right, so we're giving you guys options. It doesn't have to be that you have to have saved. You want to buy $1 million business and you have saved 100,000. You have 100,000 in pennies. It's set up in your bank account and we have the statements. There are other ways, but it goes back to.
Are you stuck trying to figure out how to actually buy a business? If you need my help, I'd love to help you kind of connect the dots. There's a lot of moving pieces. And if you haven't done it before, certainly you're going to have questions. Let me walk you through some of the scenarios and let me help you. All you have to do to set up a free complimentary call with me is reach out. You can either drop me a comment below or you can email me directly. My email address is in the description section of this video. Let me help you out.
You having some type of wherewithal, your financial wherewithal, the aggregate of all your net worth, and makes sense for you to own a business. And that's what's going to help Mary. You want Mary to be happy about what she looks at. So, this is an open book test. All right. Yeah. So I'm going to ask this because it happens. When is it possible, if ever, to have a zero down payment option?
Well, technically, SBA says you don't need an equity, you don't need equity for a startup, but it really truly is up to the bank's policy to make that determination. So each individual lender determines if they will, one, do a startup, or two, have a down payment. So, but there are expansion opportunities for borrowers to have no money down, such as expansion into real estate purchase, equipment purchase, debt refinance. Those are all some examples that you can use for, zero down under the 7A program. There's been a couple of changes where when a business is trying to acquire another business within the same industry, they can qualify with, zero down, as long as the 6-digit NAICS code is the same, they're within the same geographic area, and they have the same ownership. And of course, like we're what you're going to hear over and over again on this podcast is that the business supports the business cash flow and the repayment of the debt, right? So the existing business, has to have, decent financials and cash flow to buy another business with a cash flow. So that's kind of probably the most common one that I'm seeing right now is individuals looking to expand their core business and using that, expansion program to grow the business.
This is where I put my CFO hat on. I own an accounting firm, and I outsource CFO for dozens of companies across the country. And this is something that I coach my CEOs on is you gotta put your best foot forward. You're not ready to buy until your balance sheet is strong and healthy. You have nice current ratios, right? 1.5 or better. Gosh, if you have a 2-to-1 ratio, you have plenty of AR and in cash in the bank, and you have half of that in current liabilities, you have good working capital, right? So if you're already positioned and you have, some long-term liabilities, but you have nice equity and the balance sheet makes sense, right? Balance sheet is assets equals liability plus equity, right? So that because you're trained in that. If you look at a strong balance sheet, and that's what I tell my buyers, if you look through the most important document, financial document will always be your balance sheet. Your P&L feeds your balance sheet, but balance sheet is a permanent document. So if you're looking at it, you can able to derive it. It doesn't take long to look at a balance sheet if it looks in order, right? There's not a lot of negative anything other than depreciation. And some people have negative everything, right? So if you're losing money on the P&L, how can you ever be able to afford the debt on the balance sheet to buy a business, correct?
Correct. No, I think that's really well said. I think that, there's with the most amount of baby boomers exiting businesses between now and I believe it's 2037 or 2027, I believe is like the biggest exit of baby boomers. I think there's a lot of businesses that are, for example, in accounting, right? You're in accounting and then you see the guy down the street that's been doing it for 45 years.
Yes.
And, he's just paddling away, but he's just kind of doing his thing, but he still has a very good book of business, core customers that you're like, wow, I can roll this up into my business. I can bring in my technology. I can bring in, technology websites, like different things that person, it worked for them for 45 years, but you can now tweak it and make it more modern, and you will have an uplift in that business. So I think this is a great program for those individuals that are looking to, from accounting to expand.
Do roll-ups. Yeah.
Doing roll-ups. Yeah.
Awesome. All right, let's keep going. Working capital. Did I tell you that I went to a workshop at the IBBA only to discuss working capital? A bunch of us geeks, sitting around talking about what is excess working capital and all those good stuff. But not all lenders are created equal, right? Can you tell us can you finance working capital requirements? In what cases will you do that?
Yeah, so this is a great question because, technically SBA wants to ensure that the borrower has sufficient working capital in their business during the transfer of ownership, because once that business transfers, that's probably the most delicate part of the operations of the new borrower and the old borrower or seller leaving. And so at Live Oak, we really do a deep dive into working capital. We do finance working capital into our deals a couple of ways. One of those is that we will finance permanent working capital into the loan proceeds. So if, for example, if, their ARs turn every 30 days, then we'll look and say, okay, how much do we need? We'll put that on permanent working capital into the loan. Because a lot of times what is said is, oh, well, they have ARs coming in. And you're like, well, yeah, the ARs will come in 30 days, but what if you close in the middle of the month and you have to make payroll that Friday? How are you going to make that payroll that Friday? Or, keep your lights on if the PG&E is due that day. So having permanent working capital on the balance sheet at the close of escrow is incredibly important. And we also take a look at the Express Line of Credit, which is a phenomenal program. So maybe they don't need permanent working capital. There's a great Express Line of Credit. So sometimes we'll finance the loan, then we'll have a separate Express Line of Credit. And then there's other circumstances that make the sense for a specific deal that they may qualify for both. Of course, again, as we've said on this, you're going to hear over and over again, depending on cash flow, that we will finance the permanent working capital and give them an express line of credit. So those are a couple, options for working capital, but it is important for a business, and borrowers should really be asking themselves about working capital.
And this is really taboo for most owners, unless you've been in the lower middle market. Working capital, when you're actually running business on accrual, it's evident in the balance sheet. So do you, when you do your working capital calculations, do you do a kind of a confirmation on the burn rate, month over month burn rate, and you look at the delta between the current assets and minus current liabilities to kind of come up with a solid number?
Yes, I mean, we like to get the information of what the borrower thinks, what the seller thinks, what the broker thinks, and then we really look at, like you said, at the burn ratio and also the cash cycle of how their collections work.
Great, we're on the same page. Awesome. All right, moving on. Well, this also happens. Speaking of working capital, if the seller says, "Hey, I built this business for 40 years. I'm giving you nothing. And I'm keeping my AR." And I don't know whether this is, equity transaction or an asset purchase. There's that big, elephant in the room. It's like, which happens a lot. It says, "Hey, look, I work hard for my AR. That AR belongs to me, and that's an asset that belongs to me." But then forget that really there's going to be a space and time that there's going to be a gap in coverage on cash, right? So I think you already answered that. And you know what? When I asked you the working capital, I actually asked you two questions in one, which I already answered. What is the credit department reconciling working capital on underwriting? You already went over that. So is there anything else we want to say on that?
I think it's also interesting. Sometimes we see borrowers that are putting their last penny, let's say they need $100,000 down and they're putting $100,000 down. I think it's also important for the business to have cash as well as, personal, that they have the wherewithal to, I think with COVID, this question has come up. It's like before, people would have, personal reserves, for a couple of months. And then, later people realize, well, maybe I should have had a little bit more. So I think for a business and a personal, especially when you're, transitioning into a new business, that, you consider both and look at what those numbers, what your burn rate is personally as well.
Excellent. Which leads us to post-closing liquidity, right? There is the down payment money, the working capital question, and post-closing liquidity. What is your target for a buyer, and how do you figure that out?
Well, that's a loaded question because it changes depending on each deal, each industry. But I mean, normally speaking, I would say it's between 30 to 60 days. But it really is dependent on a business, on a particular industry and, what their collections are. I think you made it perfectly. What is their burn ratio and what is their cash cycle?
Okay, so we can argue, or we can infer to the fact that if you bought a business at the right multiple, where there is a nice debt service coverage ratio. I mean, if I'm looking at a business, and I usually like to pre-underwrite the deals before I even give it to you guys. So like, I know what you're going to be looking at. So we compare notes, right? And if I'm looking at a business that has 2.5 times, cash flow to debt service, I mean, that's a healthy business. I mean, you got 2.5 times cash flow over debt service. That's ample runway for cash, right? So in that case, there is so much business. Does it happen often? Not really. But, But there'll be the occasional, you actually bought it, we suggest 3 times cash flow. The buyer negotiates 2.5 times cash flow. The seller has to go for whatever reason. This is really a cash cow. Now, post-closing liquidity be looked at a little different, right? Okay, wait a minute. You're taking over this business that is going to give you post-debt service cash flow of $300,000 a year, right? You're right. Every deal is different. So if you guys have doubts about anything, if you're in the middle of it, please reach out to Mary, because she will if it takes her 5 minutes we're all here to earn your trust, right? And if it takes her 5 minutes to explain something that is going to take you a couple of days to figure out, reach out to Mary, right?
Yes.
Or reach out to me and I'll connect you to Mary. All right. Bankruptcy. There are more and more people, successful entrepreneurs that have gone through iterations, and they have at times lost a business, had to file for bankruptcy, file Chapter 7, and rebuild, right? When, if ever, somebody who has recovered, how does it work with, an SBA 7A loan or a 504 loan?
Yeah, so that's really specific to lenders. It's lender specific. So bankruptcy is difficult. And I was doing SBA lending after the 2009 crash. So a lot of people were just advising people to file bankruptcy, and there wasn't, it was just interesting times where it popped up a lot during that period. It doesn't seem to be as much anymore, but if you have filed bankruptcy, it's important that you have, clean credit history thereafter. It is also important that, you have time, that it wasn't something recent, that it was something long ago.
For instance, 5 years, 6 years, what, of course, we would like it to be 20 years, but some people has like 5-6 years since discharge, but they have rebuilt their lives. No,
I agree with you. And again, bankruptcy is very difficult, and there's many reasons why people file bankruptcy. I think that the areas that we give consideration is, if it has been a time, between filing, the person has good credit history, and it's linked to something specific like, death, illness, divorce, or, a specific industry. I've heard, really unfortunate circumstances, and, people had to file, and they're isolated cases. So, bankruptcy, we're going to be a little bit more tougher on, as, many lenders are. But I think if you are one of those people, make sure you have your discharge paperwork, make sure you have your explanation letter, and make sure it explains that it was related to the death, the illness, the divorce, or the isolated incident, so that it could either be, screened out quickly or, collected quickly. So that's pretty much, bankruptcy. And
fair enough.
Something else on FICO scores, that you had mentioned, it's interesting because yes, we would like to have a FICO number of X, but there are circumstances where that algorithm, for whatever reason, has a borrower that has a 650 FICO score, and they've never been late on any payments and has perfectly clean credit, right? So in those cases, we will take those borrowers. It really goes down to the fact of the payment history and the borrower's character, behind these circumstances. So yeah, I think that's pretty much about personal credit, and, in the unfortunate case of bankruptcy, it really is a case by case basis, and really dials down to payment history.
That's great. Thank you. I know that this comes up, so I'm glad that you're taking the time to answer that. It's high on people's minds. I mean, there are actually more bankruptcy that I've run into that I thought there were. There's, it happens with somebody who is entrepreneurial. Some of the most successful, iconic businessmen in U.S. history had at times multiple bankruptcies before it actually hit it big. So it's just the nature of entrepreneurship. All right. With that said, we have a couple more questions. We're going to take a break. We're going to come back to the target businesses. Stay tuned, because that's okay. We're only talking about one half. We need to talk about, so you need to watch the whole thing, guys, to get the whole feel. And we basically give you an MBA in a box with Mary here in today's show.
This big.
So yes, no pressure, right? MBA in
pressure.
finance, actually, I might add.
No pressure, no
So-
pressure.
No pressure. Okay. Employment and post-acquisition employment. So does the buyer need to be employed, yes or no, at the time of acquisition? And how long before acquiring the business can they actually leave their job, if ever?
Yeah, so I mean, the SBA wants the borrower to donate, 100% of their time towards the business that they're looking at. So many borrowers that call me that are looking to buy a business are currently employed. So, that is the topic of discussion, as well as like, how do I transfer from my current business or my current job to, the business that I want to buy? I think that in the resume, they really outline if they did have any lapse of employment, they want to probably outline that in there, why they might have a lapse of employment. But they could be employed. They don't have to be employed. I mean, it really doesn't, make a difference if they are. But if they are employed, then obviously they, have, outside income if maybe a spouse is employed and is going to continue to be employed. So I think it's a case-by-case basis as well. But SBA really wants the borrower to focus mainly on the target business.
Fair enough. What about the opposite? There'll be times, well, depending on the size of the business, I suppose, right? If you're really buying a lower middle market, $3 million business that is pretty high involved, you would expect, wait a minute, you put $300,000 down to buy this, you have the wherewithal. If not involved as a CEO, this is not going to thrive. If it is a smaller business, say like I guess a coin-operated laundry, the level of involvement is different than you're taking on an engineering firm or an HVAC or a plumbing, something in the trades. So I guess there is a trade-off between, I'm sure you're going to do your calculations, spouses, crew spouses working, one is going to lose the income. You calculate that into your global debt service cover. You do all those calculations beforehand, right?
Absolutely. That global debt service coverage includes outside income, personal debt service, taxes, living expenses, if they have any affiliates and so forth. So, having a person employed or not employed, or having a spouse that is going to continue to be employed or not employed, all of that is calculated into the debt service coverage, depending also on the standard of living, right? I mean, every person's standard of living is different, and it can be different depending in what area of California or different states that have a higher cost of living. So, yeah, I think that all of that is taken into consideration when discussing employment.
Okay. 3 more questions before a break. Hang on, everybody. What about location? Now, how close does the buyer need to be to the target business?
That's a good question. Kind of a loaded question, right? Especially after COVID. I mean, everyone says, I work remote, so how close do I have to be? So I think it depends, right? If you can't get there, within a couple of hours, then how do you, and so if you have a business that is more of a virtual based business, then, you could say, well, I live here, they live there. This is how we collaborate. Because I have seen businesses that, everybody works in their individual space, and they went away from the whole office, concept, and it has been very successful for them. But when you said, that HVAC business, you need somebody there. So you need somebody who's going to be able to drive to that location, every day. And it has to be within a reasonable proximity to where the borrower lives, because, they're going to be going there daily. So
I think you nailed it. It really depends on the industry vertical and how it behaves. For instance, if you're talking about SaaS, companies, software, anything that you can sell at tech companies, you can actually be virtual.
Right.
But if you're actually delivering, touching, you're meeting with the customer, that calls for the CEO to be on site, right? And what is reasonable? 100 miles. Every case is different, and I've seen it all. But thank you for alluding to that, because that comes up, right? There's not, I wouldn't say there's like a matrix, right? If you're between 50 and 100 miles, it's a yes. If you're over 100 miles, it's not as simple as that.
It isn't, because whatever is 50 miles, if you're doing 50 miles on the 405, that could take you a really long time.
3 days.
Right?
3 days to get to Orange County.
Right. But if you're doing 50 miles on the Highway 5, it may not take you very long. So again,
Yes.
The mileage is not necessarily the factor. It's the reasonable proximity of how long it takes you to get there.
I lived in LA for 20 plus years. Oh boy, if you have to get out of the San Fernando Valley to go to downtown, you better have a very good reason. And if you're going to the west side, even better reason. Okay, I know there's a lot going on. We're not going to get too much into that because no one really knows about changes on the SBA, partial transfer of ownership versus full transfer of ownership. What can you say about that, if anything?
Yeah, so originally, so if you had an owner, let's say you had two owners and they were wanting to sell their business, and let's say Sally and Bob are selling their business, and Bob wants to retire, but Sally wanted to stay there. It used to not be eligible unless Bob and Sally exited the business. So with the new guidelines, partial business acquisitions are now eligible through the SBA, which is now pretty exciting because we do see those opportunities. For example, there's a couple of dentists that are in practice together. One wants to leave, the other wants to stay. Well, they're like, well, how do you finance that third or that 50% or what have you? So it's going to create, I think, more opportunities for, one or more owners being able to sell, and opportunity for individuals wanting to buy in, most likely at a lower rate because it's a portion of a business. So it's going to allow sellers to stay on that want to still stay on and run the day-to-day operations that weren't otherwise eligible previously.
This is really the new frontier. I mean, you can now conceptually ask a seller who may have a trade license to stay on as a minority. They may want to stay as a 20%er, right? And the purchase it as an 80%er, and it's a whole new dynamic. And I don't think anyone knows. I know that the law is in effect, August 1st, 2023, when it actually goes, but there still can be changes made, right? And so nothing is for certain. So right now we are all operating under the assumption that right now it's 100% transfer until we're told more clear guidance. And you'll tell us, because you're hearing it straight from the SBA as an SBA lender. So, all right, last but not least, on the questions on the buy side. I get it from the buyer's perspective, having a conversation with you getting to know the buyer and you assessing, hey, I really like this buyer because of their profile. Will you be willing to issue some type of, bank scholar letter of support, letter of pre-approval, something that has a stamp of Live Oak Bank and says, hey, I have vetted this buyer. If this buyer brings the right cash flow business, we may have a deal. Are you willing to do that?
Absolutely. And I do this, this is a big part of what I do. So yes, I do issue pre-qualification letters for projects. And I must say this is also a differentiation of Live Oak Bank because our pre-qualification letters, I think, personally, I feel have an advantage in the market because we go into a deeper dive into the project initially. We're not just throwing a proposal letter out there on the street and then it coming in, and then maybe 6 weeks later, oh, by the way, we don't like that industry or what have you. On the front end, we ask more detailed questions. We conduct our cash flow. We do an initial credit review, which gives a greater approval rating in our full underwriting process. So our proposal to approval is, in the high 90% range. And so that's, a big difference than just getting a regular proposal letter, because the pre-flight proposal letters are in fact pre-flighted with a credit manager at Live Oak Bank, which gives them the confidence that that proposal letter means something. And now it's not it's not a full approval letter, but at least it gives you, red light, nope, not interested, or, yellow light, we like your deal, but we need to, dive into this, and this, or green light, gosh, we really love this deal, let's hit the ground, let's get it off, moving forward. So I really love the way we do this, and I think it really is hugely successful for our borrowers, and it gives great confidence to to the individuals, knowing that they have those conversations up front.
And the reason that this comes up is because there's 15 buyers for every good business for sale, right? Not all businesses are good, but if you have a good cash flowing business, and the broker on the sell side did their job by getting at least one SBA approval, they're going to be very judicious of the buyers that they talk to. So buyers need to really, up the game. So that's what comes up, like we're for a listing agent to actually make a sale, you have to have a qualifying buyer, right? So if a buyer comes to me and says, hey, Leo, I want to go for one of your listings, right? And individually, I talk to an SBA lender. They have vetted me. They have looked at my credit score. I mean, so all I'm looking for is the right business. That's what that comes in, right? So what I tell, buyers have a tough road with a business that is listed for sale. If it is in the open market, there are really people with deep pockets looking at businesses to buy. So if you're going to lean on an SBA loan with up to 90% LTV, you need to have every tool at your disposal to make yourself look at as a good buyer, right?
Agreed. I think you need to have a good track record. I had a project too that there was 9 different buyers that were interested in in this particular business.
Wow.
And we really want to set ourselves apart, ask those deeper questions, and make sure that our proposal letters have credibility behind them, because we really don't want to waste the borrower's time, the seller's time, or the broker's time, if it's just not the right fit.
With that said, right now we're wrapping up part 1 of. So thank you so much, Mary. Went a little longer than I wanted to, so that wraps up part 1.
Limited time, I'm giving away my cash flow calculator, a great tool to figure out exactly how much cash is left after you find a profitable business and you have to get a loan, maybe even up to 90% of the value of the business. You calculate the cap rate and the cash on cash return. 2 really great tools. It's in Excel. It's very user friendly, has been downloaded thousands of times already. All you have to do is follow the link below, and it's yours to keep as a gift to you for being a subscriber to my channel. Thank you.